This podcast is called When the Facts Change because I loved John Maynard Keynes. He's the most famous economist of the last couple of hundred years, really. A British economist who became heavily involved in setting policy, being part of the big debates after the end of the First World War, through the 20s and 30s, and right up until the end of the Second World War. He's reputed to have said, because he was a very thoughtful and clever economist, that when the facts change, he changed his mind. The phrase was, when the facts change, I change my mind. What do you do, sir? Well, this week, the facts changed in an enormous way. You could argue the central fact of the globalised economy of the post-war era was that the United States helped underwrite and run a system of world trade based on the World Trade Organization, where over time tariffs on goods and services were reduced. And the idea was we'd all end up with a tariff-free, easy-to-trade system where money, goods and services flowed freely between countries to try to maximise the good in the world. And pretty much every economist in the world agreed that. But tariffs were there for a reason, particularly after the end of the First World War and through until the end of the Second World War. Many countries felt they needed them to protect their local industries. And the United States in particular used them as an alternative form of tax because right up until the First World War, there was no federal income tax in the United States. So the only way to raise money was to put a tariff on imports. That changed through the First and Second World Wars, and over time, America has reduced its tariffs to close to 2%. In fact, where many other countries had put their tariffs until Donald Trump. Now, he put them up in his first term, and in the last week, he has unleashed Liberation Day on the global economy, putting up tariffs from around that 2% mark to more like 25%. He's taken tariffs back to where they were in 1910. It's a bigger tariff increase than what we saw in the famous or infamous Smoot-Hawley Act of 1930. You might recall the global depression of the 1930s was worsened because the United States put up its tariffs as the depression got worse and worse, to the point where global trade ground to a halt, financial markets collapsed, and in the United States at least, and in parts of Europe, many of the financial systems, the banks, also collapsed. No one wants to go back there, except for Donald Trump. And his unleashing of these tariffs has caused mayhem on financial markets. This week on When the Facts Change, we talked to Jarrod Kerr, the chief economist at Kiwibank, who's seen plenty of global financial crises in his time, but this is turning into a doozy. And we discuss the implications for the New Zealand economy, particularly in the wake of the Reserve Bank cutting the official cash rate on Wednesday afternoon. And we spoke on Wednesday afternoon, and we're keen to get this podcast out as quickly as we can before the facts change again. But it is a wide-ranging discussion in which we talk about some of the basic aspects of geopolitics. Why is it the US dollar is so powerful? Why is the United States so powerful? And we get into this issue of this clash between China and the United States, which Donald Trump sees in existential terms. And there are many people behind him who see this tariff clash as part of a wider contest between the United States and China. I often do public speaking events, and one of the questions I often get asked is, when is the US dollar going to lose its place as the dominant currency in the world? Because lots of people have tried over the years to reduce it. The euro, for example, was created as an alternative reserve currency. China has been trying to build the renminbi as an alternative currency platform for more than a decade, and without too much success. Why is it? And the basic answer I give is that the United States has many more aircraft carrier groups, nuclear-powered and nuclear-armed, than anyone else in the world. What we're seeing this week is a demonstration of power, not fairness, raw power. And this week on When the Facts Change, we talk about how that power shift and how Donald Trump's actions are going to affect us and what might happen next. How might the facts change next? Well, kia ora and welcome to When the Facts Change to Jarrod Kerr from Kiwibank. Love our chats about how facts are changing. And today, Wednesday, April the 9th, is a few days after, you could argue, one of the most important days in the history of the global economy and trade, Liberation Day, where Donald Trump upended the global order again, and this time around the global economy. What have you been thinking, and what's your sort of gut reaction when you see all this stuff happen with tariffs and all the drama?
Oh, look, it's a moving beast. I mean, we knew he was going to come out with tariffs. We just did not know that it was going to be as wide ranging and as aggressive as they were. We all know Donald Trump's a big fan of, threaten and intimidate and come up with, like a massive number that can be negotiated lower. So in the back of our minds, we're kind of hoping that happens. But China has retaliated, and then they've retaliated to the retaliation, which means there could be more retaliations. I don't know where that's going, but China started off with a 20% tariff, and now we're at 104%. And I think that there's things going on behind the scenes, potentially China selling treasuries, potentially other things going on right now that we don't quite know about. I don't know where that ends. So what does it mean? It just means the outlook for the globe is worse than what it was. The outlook for our exports and commodity prices just has to be worse than what it was, and therefore, we're putting the guards up and we're thinking, what's the risk to the New Zealand economy? And unfortunately, the bright spot, the export sector, could now be at risk, and that facts have changed.
Yeah, and something that the Monetary Policy Committee at the Reserve Bank have had to think about this week as we speak, a few hours after the Reserve Bank cut the official cash rate by 25 basis points to 3.5%, as pretty much everyone expected. It has taken quite a cautious wait-and-see approach on this issue of whether these tariffs will be inflationary and what it might do to global trade, global demand. So what did you think of the Reserve Bank's approach on this, which was very much, opening batsman, forward defensive, eyes over the ball, and making sure that they didn't get whacked?
Yeah, look, they've given themselves time. I mean, to react today, a week after Liberation Day, is still a little early, right? We need to know where the dust settles. But as they rightly pointed out, there are downside risks to global growth, therefore downside risks to New Zealand's growth, and downside risk to inflation. What's annoyed me over the last few days has been the commentators that have come out and said this is inflationary. Yeah, it is, maybe for this month, next month, and the month after that, but not in a year's time. If all the downside risks to growth play out, then actually we're facing a much softer inflation outlook. Therefore, central banks are much more likely to cut by more than hike, which is what some commentators have said. And I think we need to clear that out. And the Reserve Bank did a good job of clearing that out.
Yeah, because what we see around this tariff story, liberation story, is a political story, firstly, one that the story is being told to us by Americans, and they are facing inflation. When they import goods, the importer will have to pay a tax, effectively, to the US government, and then choose whether to add that tax on to their price and hope that it's paid for by Walmart or whoever's buying the stuff, and ultimately the consumers, or whether they eat that tax increase and keep their price unchanged. Now, it looks like a good chunk of it's going to be passed on to the US consumer, and therefore it will be inflationary. And that's certainly something Jerome Powell, the US Federal Reserve Chair, said this week that he's keeping an eye on, and he wants to wait and see too, to see whether it does turn into a big inflationary story for the US. However, you're right, that's the US story. That's not the same as our story, because we are not retaliating with tariffs. There's not going to be a new tax on New Zealand consumers and imports, thank goodness. And we are now in a market for importing things from countries like China, who may not be able to sell quite so much into the US, and is already facing deflationary pressure internally. So in some ways, not only will it slow global growth and therefore demand for a limited set of goods and services, and therefore the prices might come off globally, but China, with all those factories, is going to be pumping it out. We might be able to get some cheap stuff.
Absolutely. That's one of the I mean, it's one of the risks we've talked about before when we were talking about tariffs, right? Yeah, you might see goods diverted away from Chinese-made goods that were supposed to go to the United States diverted to New Zealand at a 30% discount, right? Because there's a 100% tariff on those goods now. And the US consumer simply won't buy that good. I know you said that's inflationary and it is near term, but there's been some good analysis out there from treasuries that show, a 10% tariff is clipping the ticket, right? That's a good way for the government potentially to drum up a bit of money, right? Okay, fine. 100% tariff, that is not going to generate much revenue for the United States, i.e. people are not going to buy that good anymore. So the fact that Trump's come out so hard on so many countries, so many products, that will divert trade. It will have an impact on trade flows. And that's why we are quite concerned, because this does mean that there's going to be a lot of carnage out there. I thought that they would have gone hard on China and not so hard on the other parts of Asia. So I thought we might have seen some trade flows through the likes of Vietnam and Cambodia and whatever. They've also been whacked with a 50% tariff, which was surprising, right?
Yeah.
Little old Cambodia whacked with a 50% tariff. So it's like, okay, wow, this is very heavy-handed and across the board.
Yeah, let's talk about how those numbers came about, because we've all seen the TV pictures of Trump holding up this board with a bunch of numbers on it, including that New Zealand apparently had tariffs on US imports of 20%. And we're all looking at each other going,
where'd that come from?
I didn't know. Is that right? And then we all, Googled the World Trade Organization website to find out what the actual tariffs were. And it's more like 1.8% or something like that. Yeah. And that was interesting to see the reactions of Todd McClay and the Prime Minister scratching their heads going, we're not quite sure where they came up with that number. Turns out, how did they come up with that number?
Well, turns out that they just took the trade balance and then came up with a percentage and halved it. So it's like, how on earth you came up with that as a good way of doing it? But I don't think that's the point. The point is the United States is looking at all the countries that are running a surplus with it. They're of the opinion that they're ripping them off.
Yeah.
Not the fact that they've specialised in it. So take New Zealand, for example. We send beef to the United States, goes in their burgers. They love it. Why do they come to New Zealand for beef? We're pretty good at providing it, right? That's our specialty. We are exceptional farmers.
And our beef is nice and lean. You mix it up with the fatty stuff from the feedlots in the United States and it works. And climate change means that their beef herd is smaller. They just don't have enough beef, and the Americans love their burgers. So we're helping them out. That's the deal. That's how trade works. You can't do something, you're not very good at it, but you have some money, so you pay someone else for that stuff. And what appears to be a piece of trade, you end up with you have a good surplus, but the trade situation you describe as a deficit, when actually you've got the stuff and they've got the money. That's that's not a bad thing.
Yeah.
That's how the world works.
And it is two-way. Like we import a lot of machinery, airplanes, airplane parts. We get a lot of good stuff, military stuff out of the United States. But that's trade. What is the United States good at? Services.
Yeah.
Really good at services.
And they've got these global tech companies which are sucking in lots of cash from the services they're exporting.
Yeah.
But even then, after the services are added to the goods, and the goods deficit in the United States is quite a bit bigger than the services deficit, even then they have been running a substantial overall deficit for a long time. And you could ask the question, and obviously Donald Trump, he's not so much worried, he's angry. He's angry about it. Well, how can America keep doing that, running a deficit? Aren't they going to run out of money at some point?
Well, as long as you trust the US dollar as being the global reserve currency, yeah, they can. New Zealand's been running deficit for a very long time. Why? Because we are trusted. We will pay you back. I once worked with a couple of economists in the United States, and they used to joke that we will always pay you back. We will always pay you back. It just might be with a currency that's not quite worth what it was when you took it out. So, there are some jokes around that, but the fact is, 60% of global reserves, 60% are in dollars, big dollars. And then it's a massive drop to the euro, 20% of global reserves held in the euro. And then you look at sterling, yen, they're very, very low. So global reserve currency status is very important, and you'll note that an even greater proportion of global trade is done with dollars. Ask Fonterra, ask any of our large exporters what they get paid in. They get paid in dollars. So Fonterra sit there all day, every day, selling dollars and buying Kiwi. That's what they do all day, every day, because they get so much.
So when Fonterra rings up on the phone and says, let's do a deal, you say, would you like to sell me some US dollars?
We know what side you're on and have been on for the whole time.
Let's look into that king dollar situation where it's the world's global reserve currency. It hasn't always been like that. One of the things I love to read and think about is world economic history. We deliberately called this podcast When the Facts Change in tribute to John Maynard Keynes. You could argue the world's most influential, famous economist of the last couple of hundred years. And John Maynard Keynes was heavily involved, not just in the initial discussions after the First World War about the reparations Germany would have to pay, but also the structure of global finance. Because before the First World War, the British pound was in effect the world's global currency. Yes. And it was backed by gold. And that gave people confidence that they were going to get their money back. Then through the interwar period and the Great Depression, Britain went back onto the gold standard and eventually had to pull itself off. And even the United States depreciated the US dollar versus gold when FDR was elected. But then John Maynard Keynes was incredibly influential at the end of the war at an event called Bretton Woods. It's a resort place in the United States, great famous hotel now. And could you tell us how that Bretton Woods event helped create the US dollar as the world's reserve currency?
Well, I mean, I'm not so good on that, actually, but I do know that, when you come out of a world war the way we did, and, the United States was very much in that war for reasons not just about being good allies, right? And they came out with the the winning hand.
So none of
basically.
their industry was destroyed. They were the most powerful country in the world. They had the atomic bomb. They were, in effect, the world's centre of economic and military and political power. So if there was going to be anyone in the world you trusted with your money, it was going to be the US government, because when you lend your money to the US government, you get a treasury in return, and you know that the US government is going to pay you back. And that's been one of the sort of foundational aspects of the global financial system for the last 50 or 60 years, really.
Yeah.
And that US treasuries market really is the basis of the world's financial markets generally. It's something that even the Chinese government, who aren't a big fan of the United States, they have put the biggest chunk of their reserves into US treasuries, because when they make trade surpluses with the United States, they've got lots of US dollars in their hands, and they have to put it somewhere. If they try to bring it back to China, that would destabilise their system, and they quite like the idea of having US treasuries. However, over the last decade or so, China, as it starts to challenge the United States as one of the world's great powers, has been trying to build their own reserve currency.
Which hasn't worked.
Which hasn't worked. It's called the renminbi, and it's a version.
It's not set up yet.
No. And tell us how, over time, that contest about who's got the world's reserve currency, how that's gone, whether the Chinese have had much success.
Short answer is not really no. They're not set up for the free flow of capital that you require to have that status. Plus, they don't have that trust yet, right? They need to earn it, and they just don't have that trust yet for global reserve managers to say, well, I am actually going to put a serious allocation here. No.
Because Fonterra, as you mentioned, sells a lot of milk powder and other things to China. And in theory, the Chinese could say, hey, we'd like to buy your milk powder, but we'll give you renminbi instead of US dollars. And you could store the renminbi in a Chinese government bond because we are a reliable government. You can be sure that we're going to pay you back when the term of the renminbi bond comes up, and we'll pay you an interest rate, and we're just as reliable as the United States. Why haven't people necessarily bought into that? Because in theory, hey, what's the difference between the United States and China? They're both big military powers. One of them is at the moment a democracy. China is not. Why is it we haven't quite said, yep, we trust you more than we trust the United States?
Well, there's a lot more trust online than there is in reality, right? There's a lot of people that talk about BRICS currencies and let's get out of the dollar. Well, actually, that's very hard to do when you are a fund manager with trillions of dollars, right? It's easy to do when you're a fund manager with millions of dollars. You can say, I don't want dollars at all. Fine. But try doing it when you've got $1 trillion, and you need the first thing that you should look at as a fund manager is liquidity, and then you start looking at all the other things, and the United States ticks all the boxes. I remember doing a little bit of analysis in a previous life, and we looked at what we called the war trade. Now, what's the war? Why a war trade? Well, now is precisely the war trade. What do? Well, before you run home and tell your family that there's a war that's about to break out, before you do that, you sell Kiwi dollars for starters. Why? Because we're, very commodity-driven currency. We're seen as a proxy for Asia. Lots of reasons to sell us in a really destable environment. What do you buy? Well, what currency do you think's going to win? United States. Why? Because of this post-war era, right? What other currencies do you buy? Well, you buy the Swiss francs. Why? Well, They seem to last through wars quite well. And then you could buy the yen or you could buy other bits and pieces. But basically dollars is at the top of that. Then you start thinking about gold and other things as well. But dollars comes out top every time since World War II.
And one of the reasons it still has that strength is that we've seen a demonstration over the last 3 or 4 years of what happens when the United States uses that currency strength and the financial architecture that goes with it, the so-called SWIFT system, in which banks around the world have the ability to essentially wire money to each other, often it's US dollars, and that is subject to US control and sanctions. And they can and have used that system to stop certain countries' banks from shifting US dollars from one place to the next. And in theory, if assets in US dollar terms were stored somewhere, the US would have some say over what's happening with that. And when Russia invaded Ukraine,
I was just going to say that. Yeah, go.
So what actually happened when Russia invaded Ukraine, and how did the US use that privilege, that strength, that currency architecture to do its thing?
Well, the Russian ruble's down, I think 35% in the last couple of years, right? It's massive. The Chinese yuan is down 30% over that time frame as well. So that's the B. No, sorry, Brazil. You wouldn't want money in anyway. So the B, you wouldn't want money in. The R is on the wrong side of the war. The I would buy all day, every day. India, I'm fully on board in India. The C, again, is on the wrong side of the war. And then the S is South Africa, and South Africa's a basket case. So you've got BRICS. It doesn't spell out well. So this whole, getting out of dollars and getting into, I don't know what, Bitcoin? Yeah, sure. Over a really long time. What else are you getting into?
That's right. Well, interestingly, one of the things that the Russian and Chinese central banks have been doing the last couple of years, just quietly selling some of their treasuries and buying gold.
Yes.
Which has seen the gold price rise to a record high. And you do wonder, though, how much more US dollars can be put into gold without the price going crazily high. And just to finish off, Jarrod, we've had these big shifts and, the cut in the official cash rate, a fall in global markets. We haven't actually talked much about the New Zealand dollar, which has had a big shift this week. What happened there?
Well, so it's been interesting. We've thought the Kiwi dollar's been a little stronger than it should have been for a while. Our forecast was for the Kiwi dollar to drop to 55 cents. We got close to there late last year, so we've kind of kept that as our forecast, and we're close to that today. I'm starting to wonder whether we actually drop a bit further. So yes, we've fallen from 58 cents just last week to 55 cents, close to. Today, we'll bounce around. What are the risks? Well, both the Kiwi and the Aussie dollar are at risk here. We're very vulnerable to trade wars and significant slowdowns in Asia. We are quite close to that economic blowback. So we are concerned, and where will the volatility play out? It'll play out in the currency. So currency will move more than rates, and we could see the currency in the very low 50s, if not high 40s, and that would just be on the back of dollar strength, which was what we're talking about here, and commodity currency weakness. We get hit double-sided.
However, one of the good things about a floating currency is that it becomes a shock absorber, and it was interesting to hear the Reserve Bank talk in its statement about how some of the shock will be absorbed by that fall in the currency. And we always like to finish on good news. There is some good news when you're thinking about how much it costs to fill your tank with some fossil fuels. The oil price has really fallen in the last week or so, about 15%.
Yeah. as you'd expect in a situation like this. Commodity prices driven by growth, right? You've got an economy, global economy that's doing well, commodity prices generally rising, a global economy which is hemorrhaging and there's all these risks and uncertainty, commodity prices fall, right? And that's what we're seeing, and I think that continues, at least near term. So, yeah, we get that relief. Yes, the currency does a lot of work for us, which is great. So our exporters, which face just a 10% tariff, the currency's, taking a lot of that off for them. So they might not have to lower their price at all. It might just be, the US consumer that wears that little bit. So we are on sale. We have gone on sale for foreigners, which is nice. And that does help rebalance the economy. But right here, right now, the upside risks that we had, they seem to have evaporated. The downside risks that we were fearing turning out to be a little worse than we thought. Will we fight our way through it? Damn straight, absolutely. What will happen here? The worse things get, the more central banks react. So let's not forget that central banks haven't done anything yet. They will step in if it gets really out of control, which it looks like it will. What will they do? They'll shore up financial markets by buying bonds and stabilising interest rates. We saw that again and again. They will cut their cash rates in order to try and stimulate growth again. We're starting from a position which is actually quite good. There was global growth momentum coming into 2025, and inflation had basically returned to target. So we're starting this year in a really good starting point. So what are we expecting? A lot of volatility, some downside risks, but central banks will step in, which is why we're saying the Reserve Bank needs to cut to 2.5. Stop mucking around with a cash rate that is 50 basis points above neutral, i.e. it's restrictive, it's restraining growth even after a recession, and let's get into stimulatory territory. And I think they'll be there by the middle of the year.
Jarrod Kerr, Chief Economist at Kiwibank, thank you so much for coming in on a week when the facts really did change.
Mm-hmm.